A very good morning, friends. So I hope your revision is going good and you've been able to take a good time to revise things on consolidation. So last class, we made a quick mind map on the consolidation process, the 7 steps which I gave you. We're going to start with some more practice questions with you on Index 110. So picking up some very interesting questions in the morning. One would be without a chain holding, and the other one is going to be on the chain holding. We're also going to focus today in terms of Index 111 as well as question on Index 28. One of the very interesting questions on Index 28 which awaits you is what is addressed by the appendix to the standard. But I think before that, I think as we start a question on Index 110 consolidation process, let's quickly just take a recap in terms of what we learned in the previous class, and we identified a total of 7 steps to be applied. You just need to be very clear and focus in terms of what you need to do in these 7 steps. The very first step is very simple and straightforward. You just need to identify the date of acquisition and the percentage of holding, which is not a challenge at all. Second step is to be divided in terms of 2 parts. You need to be very cautious that when you're doing your step number 2, you need to split your step number 2 in terms of 2 parts. One is you do the analysis of other equity. And the second is you need to get the net assets on the date of acquisition. Now, I also give you 3 focus points when you're looking at the step number 2A. You need to consider the analysis of other equity of the subsidiary company. You need to take care of the fair value adjustments which are given in the additional information. You also need to take care of the stock reserve, which is supposed to be upstream in nature. So when you're looking at the step number 2A, your mind needs to be focused on 3 crucial aspects. You need to consider the analysis of other equity of the subsidiary. You look at the additional information for any fair value adjustments. You look at the additional information for any stock reserve, which is upstream, not downstream in nature. Then comes the aspect of step number 3, wherein you just organize the purchase consideration. Then comes the step number 4, where you calculate the NCI on the consolidated balance sheet date, considering the NCI on the date of acquisition, and then adding a share in the post-acquisition earnings, which of course you get it from the step number 2A. The step number 5 is the calculation of goodwill, which is pretty much an application of just applying the concept. The step number 6 is again a very crucial point because that gives you the status of the other equity in the consolidated balance sheet. Now, when you're looking at the other equity in the consolidated balance sheet, trust me, you've got another 3 focus points. The first is you take the holding company's profit as a base. That, of course, is always the case. So the crucial focus points is you need a post-acquisition share in the profits of the subsidiary, which of course you're going to get from step number 2A. Then you need to take care of goodwill impairment to be booked. And then you also need to take care of the stock reserve in the additional information, which is downstream in nature. So immediately when you're looking at the step number 6, 3 focus points should hit you. I need to consider the post-acquisition share. I need to consider the goodwill impairment. And I also need to consider the stock reserve, which is downstream in nature. Then the step number 7 is all about making the consolidated balance sheet, where you just need to keep the basic principles of consolidation. That was a quick review in terms of what we need to take care of. Now, another very crucial point. Before you apply these 7 steps, I would say if you see any kind of omissions in the question, it's either the parent company or the subsidiary company which has missed out any kind of omissions. then in that particular case, I would say before you proceed with the seventh step, you need to make an extract balance sheet as well. And this is exactly what happened in one of the examination questions which came in the exam, where the examiner gave us the concept of omissions and we were required to make an extract balance sheet. So I think let's begin a journey with an examination question to you. So let me share on the screen. Question number 12. This is an examination question. And I think this question came in January 21. It came for 15 marks in the exam. So I think let's have a look at this question. Let's read the data. Now, we're given, first of all, in this particular case, on 1st April 17, A acquired 80% share capital of S. And then it says, on the acquisition date, the share capital and the reserves of the company S is given. So date of acquisition is 1st April 17. And we can see later the balance sheet is given on March 19. So there is a 2 years post acquisition. Then he says on acquisition date, the share capital and the reserves of S is given to me 5 lakhs and 1 lakh 25 respectively. Now, when one looks at this information that the share capital and the reserves on the date of acquisition is given, the tendency is already the net assets on the date of acquisition. But my advice is do not get carried away with this information. Even though the share capital and the reserve is given, we should still get the analysis of equity because there could be fair value adjustments. But even otherwise, even though this information is given, we need to get the analysis. Then he says A paid an initial cash consideration of 10 lakh. Additionally, A will issue 2 lakh equity shares with a nominal value that is face value 1 at a current market value, which is 1.8. So the consideration is paid in cash. The consideration is paid in the form of equity shares. It is also agreed that A would pay a further sum of 5 lakhs after a period of 3 years. Now, when you make a payment, which is after 3 years, it could be a deferred consideration or it could be a contingent consideration. Now, if it is dependent upon conditions, it could be a contingent considerations, but if it is not, it is a DC. Let me, I think, put that question to you after reading the further information. The cost of capital is given 10% and the discounting rates are given. So very quick question to you. So when it says A would pay a further sum of 5 lakhs after 3 years and nothing else is stated in the question. So would you like to tell me, is this a DC or is this a CC? I am not given any ifs and buts in the question. We're just simply given the information that this money is payable 3 years later. So what do you say? Is that a deferred consideration, DC, or is it a contingent consideration? Let's get that answer from you. So DC or is it a CC? Any inputs on that, friends? And that's very interesting, absolutely correct. A very good morning, DC, that is absolutely correct. Now, the moment you start looking into this DC, then he says the shares and the deferred consideration have not yet been recorded by A. It's a clear-cut case of omission. Now, once it is a clear-cut case of omission, I think what should immediately come to your mind is making an extract balance sheet. Now, another thing which should immediately come to your mind is when there is an omission of a DC, I think there is another thing which should also come to your focus. Would there be any other entries which you would be required to do from 1st April 17 to March 19? Because when you're considering a DC, you will consider a present value of the future payment. So I think a quick question back again. So what do you say? Because of this omission of DC, would it also lead to any other omissions? Would I also need to pass any other entries in this particular case? And I'm very keenly looking at that interesting term. Because when we did India's 103, we were talking in terms of omission of a DC leads to something. What do we call that something as? It's a common rule in India is when you consider discounting, then what happens in the post later period? What is the technical word called? Okay, think about this. Then I think we'll come to the extract balance sheet as well. So think about what do you call this as? When you take a present value of a future payment, then in the future, you need to do something which is called a three-letter word. Okay, let's go ahead. So then he says the balance sheet of A and S on March 19 is given. I think I'll have to answer that. I didn't get inputs on that. Unwinding of discount. That's right. You said rewinding of interest. That's correct. Technically called a UOD. That's an unwinding of interest. Absolutely. So then I am given the balance sheet of A and S on March 19. And then let's see what is given in the additional information. It says on the date of acquisition, the fair value of S plant exceeded the book value by 2 lakhs. That is undoubtedly a fair value adjustments. And this is going to be taken care when we consider the analysis of equity that is in step number 2A. The plant had a remaining life of 5 years on this date. The consolidated goodwill is impaired by 2,58,000. Now, this impairment is borne by the parent or NCI would depend upon whether the goodwill is full or partial. And I think that would be available once we know that NCI is taken at a fair value or NCI is taken at past. Then he says A Limited values the NCI using a fair value method. And the fair value of this NCI is given. So I think undoubtedly I should ask you, in this particular case, the NCI is taken at a fair value. So goodwill is supposed to be a full goodwill, or is it supposed to be a partial goodwill? Because if it is full goodwill, the impairment is borne by the parent and the NCI both. And if it is a partial goodwill, the impairment is going to be borne only by the parent company in this case. So what do you say in considering that the NCI is at a fair value? So is that a full goodwill or is this a partial goodwill? And then it says you're required to make a consolidated balance sheet on March 2019. I think the focus of the examiner has been more on the omission part. There is hardly any adjustments given except for fair value adjustments and the goodwill impairment. So 3 focus points are there. So there is a goodwill impairment, focus 1, there is a fair value adjustments, and there is an omission. Okay, so I did not get the inputs regarding goodwill is full or partial in nature. I think I'll have to answer that as well. NCI being at a fair value, the goodwill is going to be full, so the impairment is borne by the parent company and the NCI both. Okay. So as we decided earlier, what we need to do in this particular case is, since it is a case of omission, I would say we should make an extract balance sheet. So what I'm going to do first of all to begin with, I'm going to first of all make my extract balance sheet. So my advice is that when you're making the extract balance sheet for the omissions, you first need to put the journal entries very carefully. And these journal entries need to be put according with the dates. So I think let's come back on the first para in the question. So we are given that shares and the deferred consideration is not yet recorded in the books of A. So we're going to put the entries in the books of A Limited. So let's see what are the entries in the books of A Limited, which is the parent company. So we're looking at first of all the journal entries. So I think let's first focus purely on the entries and that also on a date wise. So we know that on 1st April 2000, on 1st April, that is 2017. So we given on 1st April 2017, I am given, we're going to put the journal entry. Now the question rises, what will be the entry for the payment of the purchase consideration, which is in the form of shares as well as in the form of DC. So can I say the entry is going to be investment account gets a debit, the investment gets a debit, equity share capital gets a credit, and if there is any premium, the share premium is going to get a credit. So I think let's put across the questions to you. So we're clearly given in the question, A will issue 2 lakh shares with a face value 1 at a current market value of 1.8. So can I comfortably say that the investment is going to be recorded at what value? Can I say this will be 2 lakh shares at the rate of 1.8 per share? And that's rightly given. It works out at the rate of 1.8. Wonderful. So this is going to be 3 lakh 60. Can I say we're going to record the face value as a part of the equity share capital? So this is going to be 2 lakhs is the face value. And we can comfortably take the balancing figure, which is 1 lakh 60 as the share premium. Super. So I think this is the entry which is done on the date of acquisition. Now, even if A Limited forgot to record this particular entry, will there be any subsequent entries which will be done from 1st April to 31st March? Would the omission of this journal entry lead to any other entries for the next 2 years or nothing else to be done? I'm not talking of DC. I'm just focusing on the entry with regard to the omission of recording the issue of shares. Would there be any other journal entries to be done for the next 2 years to come? I would say no. Nothing else is to be done. The entry was omitted. This would not lead to any further changes. Then we also forgot to consider the deferred consideration as well. So we need to put an entry for the DC, and this is going to be investment account debit. And the deferred consideration, the DC gets a credit. Coming back to the question, what is the amount to be recorded in terms of the deferred consideration? It says it is also agreed that A will pay a sum of 5 lakh rupees after 3 years. So can I say I am already given the discounting factor? Third year is 0.75. So can I say we take the present value of that 5 lakh? So 5 lakhs is the DC into 0.75. And this is going to give us 5 lakh into 0.75. That's, I think, to the extent of 3,75,000. That is the present value of the consideration. Absolutely correct. Makes good sense. Okay, now another question which also comes to the mind is, once you've recorded this amount of consideration, the next agenda is, would there be any further entries which I would need to do? I don't know, trust me, many a times you're going to look at the solutions as well. Many people do not make any extract balance sheet. They directly incorporate this when they come to the subsequent steps. But, I would insist and I would request that, when you're looking at any kind of omissions, it is a good idea that for omissions, you must always make an extract balance sheet. So the next issue which is coming to the mind is, would there be any entries which I would do for the year ended 31st March 18 and for the year ended 31st March 19? I think we just decided that. So on 31st March 2018, can I say I am required to do what? Unwinding of discount. And what would be the journal entry for the purpose of unwinding? Can I say the finance charge gets a debit and the deferred consideration gets a credit? So in this particular case, when you're going to do the unwinding, can I say on 3,75,000, we need to consider a 10% interest, and that works out at 37,500. That is the unwinding of the interest. Now, let's, I think, ask you another question as well. The unwinding will also take place on 31st March 2019 because 2 years have already passed by. So my quick question now to you, when you're going to consider the interest for the next year, that is 2019, can you tell me the interest is going to be taken on which figure? Is it going to be taken on 3,75,000 or are you going to add the finance charge and calculate the interest on the cumulative figure? So is it going to be 375 or you're going to add 37,500 that makes it 4,12,500 and then take the interest? So what do you say? The entry remains the same. Finance charge gets a debit and the deferred consideration gets a credit. So are you going to consider the interest on 375 or is it going to be on the cumulative amount that is including 37,500? So this works out at 4,12,500 and I think that's rightly given again. That's correct. So we need to consider the cumulative figure on which we're going to consider the interest and this is I guess 41,250. By the way, there is another quick question also which is coming to the mind, and I think that's going to be pertinent because when you're going to make the extract balance sheet as well, I think that point will definitely hit the mind. So we are going to make an extract balance sheet on 31st March 19. So the question is, when you're going to make the extract balance sheet on March 19, are you going to show the DC as a current liability? Or are you going to show the DC as a non-current liability? Remember, the total tenure of the DC is 3 years and 2 years have already elapsed. So is this DC going to appear as something which is payable in current liability or non-current liability? I think you can decide that well. Just another 1 year to go, and that's, I think, rightly given. Absolutely correct. It becomes a current liability. Wonderful indeed. I think with all these entries done for the emission, we are ready in terms of making an extract balance sheet. It's always a good idea that before you proceed with the question, if there is any kind of omissions, make an extract balance sheet. It's going to be a wonderful idea. So we are making this extract balance sheet as far as A Limited is concerned. So let's do one thing. Let's see the changes. Now, I'm also going to give you a very simple, technique with which you do not go wrong. That when you're making your extract balance sheet, just to ensure that you've taken care of all the missing inputs, I think it's a good idea what we're going to do in this particular case. I guess what is changing is investments. What is changing is the equity share capital. What is changing is the share premium and the DC and the retained earning. So on the asset side, what is changing is just the investments. So let's take the asset side, non-current assets, and let's take the investments into account. So we're just changing the investments in the balance sheet. Let's go back to the balance sheet of A. Now, this balance sheet is already given in terms of 1,000 and the investment is already appearing in the balance sheet to the extent of 1,000. Now, this 1,000 is nothing, but it is the initial cash consideration paid. So we can say that this 1,000 which is appearing in the balance sheet is the cash consideration which is paid. And to this, we need to add two things. Now, as you add, what you can do, you can just ensuring that I'm just putting a red color that I'm taking a track of this. Let's add 360 and let's add 375 in terms of 1,000. So the investment is going to change. You're adding the shares 360, you're adding the DC 375. So this is going to give you the investment in the balance sheet. 1,000 plus 360 plus 375, that works out at 1,735. That's it. What changes on the asset side? Now we need to do the changes on the equity and the liability side as well. So in terms of the equity, what we're going to do is we're going to make the changes in terms of two elements. One is the equity share capital and other is we want to change the other equity. And in terms of other equity, you've got changes in share premium, you've got changes in retained earnings. I'm going absolutely systematic because when you're considering the changes in the balance sheet, there is going to be a change in the equity share capital, share premium, and that finance charge is going to change the retained earnings. And I think least we forget, we also need to take the current liabilities in which we need to record the DC as well. So let's go one by one. Let's go to the balance sheet of A. The share capital in the balance sheet is appearing to the extent of 2000. So we take the equity share capital. This is to the extent of 2000. And if you come back on the entry, the equity share capital is given a credit to the extent of 200. So let's add this increase in the equity share capital. This is 200. So this works out at 2200. This is the new equity share capital. Similarly, as far as the other equity is concerned, there is no existing share premium. So we can take this 1,60,000. So this becomes 160. So the equity share premium appears at 160. We're just incorporating all the informations in the journal entries and putting them as a part of the extract balance sheet. Similarly, we can go to the retained earnings. The retained earnings in the balance sheet is appearing to the extent of 1400. So let's take the retained earning existing is 1400. And what you need to adjust in terms of the retained earnings is there is a finance charge 37,500 and 41,250. So this finance charge is going to be debited to the retained earnings. So in the extract balance sheet, this will also undergo a change. So let's take this as in terms of 1,000, 37.5 and 41.25. So this is 37.5 and this is going to be 41.25. This is the adjustments to the RE. So out of 1400 minus 37.5 minus 41.25. So this works out at 1321.25. So this is the amount which is there as far as retained earnings is concerned. Let's go back to the entries. The first entry is completely incorporated. Everything is turned red. And I think in the second entry, the DC is pending. And in the third entry, the DCs are pending. So what do we need to do? We consider the DC, that is 375. Let's make it red, just to keep a track. Then this is 37,500, so plus 37.5. And then it is 41,250, so plus 41.25. The DC is 453. The DC works out at 453.75. That is the DC. Now you can see very clearly what we have done. We've incorporated all the entries in the balance sheet. And you know, in order to incorporate these entries, what I have done, I have kept incorporating the entry, keep marking them as red color. So that you know, by the end of it, you know this very carefully that yes, I've incorporated the entries. Now you would also say, so in the exams, I'm not going to use the Excel sheet. So I'm not going to make them red color. Then what is, what am I supposed to do? You can maybe put a small little tick and just keep a track that, okay, this entry stands incorporated in the extract balance sheet or not. Okay, so I think this is done. So my extract balance sheet is taken care. Now remember, in any of these subsequent steps as you proceed, you need to consider this extract balance sheet itself. Like for example, when you go to work upon the step number 6, you need to consider the other equity from the extract balance sheet and not from what is given in the question. And that's going to make our life simple. So far, so good. I hope you're absolutely connected with me to the stage. Got the points, I guess. Okay, that's wonderful indeed. So once the extract balance sheet is taken care, now I think let's go further. And what I'm going to do, start my journey on the 7 steps with you. So let's begin, and we've got the step number one. Trust me, if you go step by step, there is no way you can go wrong. Trust me, there is no way you can go wrong. Step number one, we're going to get the date of acquisition and the percentage. So in the date of acquisition and in terms of the percentage, let's organize the data, the date of acquisition and the percentage as well. So date of acquisition is given to me 1st April 2017. And as far as the percentage is concerned, very clearly given at the very start, A acquired 80% share capital. So we take this percentage as comes to 80%. Okay, so I think that step number one is done. And now you need to go to the step number 2A. And this is going to be analysis of other equity. And I think as I started off today, I also gave you the inputs again that when you're looking at the analysis of equity, there is step number 2A. I said you need to keep in mind a total of three focus points. First of all, you need to focus on the analysis of the subsidiary. Then you need to take care of any fair value adjustments, and you need to take care of any stock reserve, which is upstream in nature, and then accordingly proceed. So let's first of all define, make the columns, we consider particulars, and we define the pre-acquisition profits, and we also define the post-acquisition profits. And we can define this in terms of date. This is pre-1st April 2017. And this is anything from the date of acquisition, 1st April 2017. Can I say to 31st March 2019, which is the consolidated balance sheet date. So I think whenever you do the analysis of equity, it's a good exercise that you should first of all define clearly in terms of dates that what are we going to consider in this case. So that when you do the analysis, you're very clear in terms of the profits, how much is pre and how much is post acquisition. Now, what we're going to do first of all, go back to the balance sheet of the subsidiary. Now remember, sometimes what starts coming to the mind is I need to look at the extract balance sheet. I don't need to look at the extract balance sheet in this case because the extract balance sheet has made the changes in the books of A. There are no changes as far as the subsidiary is concerned. Now, if you look at the retained earnings in the balance sheet of S, that is appearing to the extent of 300. Let's, I think, go back on the first para, and it tells you very clearly that on the acquisition date, the share capital is 5 lakh and the reserve is 125. So on the acquisition date, it was 125. On the balance sheet date, it is 300. So would you like to tell me what is pre and what is post? We have the balance on the acquisition date, 125. And we've got the balance on the balance sheet date, that is 300. So would you like to tell me how much is pre and how much is post in this case? So let's get the inputs on your side. Split the 300 between pre and post acquisition in nature. Though I've already given you the hint. The balance on the acquisition date is 125 and the balance sheet date, the balance is 300. So what is pre and what is post? And that's absolutely correct. 125 becomes pre and you can say the rest becomes post in nature. Wonderful indeed. Super. So we can fit in this. So we've got retained earnings. 125 is pre and 175 is post. Now what do we need to do in this particular case? Go to the additional information and find out the impact of any fair value adjustments in this particular case. Let's come back on the additional information. So we are given in the point number 1, on the date of acquisition, the fair value of the plant exceeded the book value by 2 lakh. And the plant has got remaining life of 5 years on that date. So very clearly, we are given the fair value and the book value difference is supposed to be 200. Now, this fair value difference on the date of acquisition is always pre-acquisition in nature. And once you consider the calculation of the fair value, you know that you also need to consider the additional depreciation. Would you like to tell me how many years of additional depreciation are you going to consider in this case? The asset in this particular case has got a remaining life of 5 years. Your acquisition date is 1st April 17 and your balance sheet is March 19. So would you like to define me and tell me how many years of additional depreciation are you going to consider in this case? And that's absolutely correct indeed. 2 years. Wonderful indeed. So what we're going to do, we can consider the additional depreciation on 200. So we can consider on 200, 5 years is the depreciation that works out to 40 per annum. So when you get the depreciation 40 per annum, so we can say the 2 years depreciation is going to be 80. Let's reduce that 80. Super. So we've done the two focus points. The analysis of the equity is done. The fair value adjustments are done. And are we given any stock reserve which is upstream in nature? No. So we're just given a goodwill impairment. That's it. Nothing else is given. So I think this is done. So we can comfortably get the data. So the pre-acquisition is 325 and the post acquisition is supposed to be 95. So this takes care of my analysis. And trust me, when you're going systematic step by step, you cannot go wrong. I always tell people there is a huge importance in terms of proceeding on a step by step basis. The moment you proceed on a step by step basis, your focus is what is to be done at each and every stage. Now let's go to the next step. The next step is supposed to be step number 2B, which is the computation of net assets on the date of acquisition. Sorry, not on the date of acquisition. Yeah, sorry, date of acquisition. Now, when you're calculating the net assets on the date of acquisition, immediately what comes to the mind is, immediately what comes to the mind is in this particular case, that you need to add the sum total of the equity share capital as well as the pre-acquisition equity. So you need to add the amount of pre-acquisition equity as well, because net asset is simply adding the share capital and the pre-acquisition equity. Now, if you look at the share capital, be cautious. You don't need to take the share capital from the extract balance sheet because that changes were in the books of A. We are taking the share capital of the subsidiary, and that's 500. So the share capital is 500 and the pre-acquisition equity is 325. So we get the sum total of the net assets as well. Super. So the step number 2A and step number 2B is done. And I think step number 2A becomes one of the crucial steps with which, the major fight gets over. Now we go to the step number 3. And the step number 3 is the calculation of the purchase consideration. Would you like to tell me where are you going to pick up the purchase consideration? I think that's a pertinent question. When you go to pick up the investment which represents the purchase consideration, would you like to tell me which step are you going to pick this up from? The source of the investment. What do you say? I think that's a very pertinent question. So when you need the investment, which is the purchase consideration, so would you like to tell me where are you going to pick that information from? And you said a DC and a PHI. No. I actually wanted to hear that we're going to pick this from the extract balance sheet, because we've made the entries and extract balance sheet for all the omissions. And yes, that's what I wanted to hear, that you're going to pick this from the extract balance sheet. Super. So let's go back to the extract balance sheet. and the investments is appearing at 1735. So this works out at 1735. Great. So now with this, we can go to the step number 4. And the step number 4 is the calculation of the NCI on the consolidated balance sheet date. Now, when you're calculating the NCI on the balance sheet date, you need to keep your focus points clear. That we need to first of all get the NCI on the date of acquisition. And to this, we need to add the share in post-acquisition share. So you'll add the share in post-acquisition profits. So I think first what we need is we need the calculation of the NCI on the date of acquisition. And this is clearly given in the point number 3. It says A values the NCI using a fair value method, and on the date of acquisition, the fair value of the NCI is supposed to be 380. So we take this as 380. And what about the post-acquisition profits? You're going to get that information from the step number 2A. So let's go to the step number 2A. The post-acquisition profit is 95. So can I say out of this 95, you need to pick up the share of the NCI. That's absolutely correct. So now if you need the share, I think the parent has got a total stake to the extent of step number 1, 80%. So 20% belongs to the NCI. So let's take 20% of this that belongs to the NCI. And I think that's coming to, I guess, 90. Is there anything else which needs to be adjusted in terms of NCI? Is there any other focus points we need to be careful on when you're calculating the non-controlling interest? Very good. We need to make a reduction of the impairment. Since you rightly said the NCI is at a fair value, so there is a need in order to reduce the impairment of goodwill as well. Wonderful indeed. So we take the impairment of goodwill. So once I take the impairment of goodwill, now if you go back to the additional information in terms of point number 2, the goodwill is impaired to the extent of 258. So what do we need to do? Out of this 258, we take a 20% hit. So we can reduce the amount of impairment. 20% works out at 51.6. Okay, so I think with this inputs, we get the amount of goodwill, amount of NCI, that is 347. So this gives me the NCI on the date of consolidated balance sheet. Wonderful. Now we go to the next step, and that is the step number 5, which is going to be the calculation of goodwill. Now, when we calculate the goodwill, initially, of course, it's going to become a mechanical exercise because you just need to add, 2 items, add the purchase consideration, add the NCI. And remember, when you add the NCI, you're adding the NCI on the date of acquisition. And then you consider the net assets on the date of acquisition. So you're going to get the goodwill. So let's, I think, take the figures from the previous steps itself and fit in the data. The purchase consideration is step number 3, 1735. That works out at 1735. Now you need the NCI. So do we take that 347 or do we take that the 380? We are calculating the goodwill on acquisition date. So when you take the NCI, we need 380. That's absolutely correct. So let's take the sum total of this. So that works out at 2115. Net assets available in step number 2B, that's 825. That is the net assets on the date of acquisition. So I think let's calculate the goodwill in this particular case. And is there anything else which needs to be done, taken at this stage further? So any further adjustments to be done in terms of the step? Any other focus points to be done? Wonderful indeed. Goodwill impairment is to be taken. And are you going to reduce the entire impairment, or are you going to consider 80%? Because that is also one of the most common mistakes people tend to do, that when they're calculating the impairment loss, in this particular case, they'll end up considering 80%, and that's wrong. Yes, you're absolutely correct. We need to consider the entire impairment of 285, 258 itself. So that is, I think, another important agenda, that when you're considering your goodwill calculations, impairment is always a reduction completely. So this is going to give you the goodwill post the impairment. So this is done. Super. Step number 5 is done. Then we go to the step number 6. And trust me, as you proceed step by step, you will also get a confidence that yes, you're going absolutely correct. There is no error in the calculations. So then we go for the consolidated balance sheet other equity. So here again, we've got a total of 3 focus points again. Because as we said, when you look at the step number 6, there are again a total of 3 focus points in this case. One is you need to consider the post-acquisition share, one is the goodwill impairment, and one is the stock reserve, which is downstream. We're not given any stock reserve information, so nothing is to be taken. Now, we need to be careful. Would you like to tell me where are you going to pick up the holding company's own equity in terms of RE and in terms of share premium? So what is the focus point? Where are you going to pick up the information for the holding company's own other equity in this case? Wonderful. Extract balance sheet is what we need to pick up out. So let's go back to the extract balance sheet and we pick up the information. That's good. So I guess the share premium is 160 and the retained earnings is 1321.25. So this is 1321.25 and this is to the extent of 160. Let me just quickly check the figures again. Yes, it is correct. So now we've got the 3 focus points. Once you picked up this information from the extract balance sheet, we need to add the share in. We need to add the share in post-acquisition profits. So in this particular case, you go back to the analysis and pick up the information once again from there. And that's absolutely correct. So in this particular case, let's go back to the analysis. So the post-acquisition profits is 95 and 80% of this. So this is 95, 80% of this belongs to the parent. So let's take 80% of this, that's 76. And then in this case, we also need to consider the goodwill impairment as well. And that's right. So now let me, I think, put across that question also. I think it will be a good one to put that. So goodwill impairment in this particular case is going to be 80%, or are you going to consider the goodwill impairment to the extent of 100%? That's also important to put across. So are you going to consider 80%? That's right. So we take the goodwill impairment that is to the extent of 258 into 80%. It's only when you calculate the goodwill, then you need to reduce the entire, otherwise we need the parent and NCI share. So this is going to be 206.4. There are no stock reserve calculations given. So I think that takes care of my step number 6. Okay, that's wonderful indeed. So this is done. Correct. If it is Pasna, it's going to be 100%. That is absolutely correct indeed. Okay, so I think we maintained a very simple, straightforward pace. I did not go fast intentionally. I thought, it's good to go with your flow because otherwise I'll end up doing the question on my own. So I thought we'll go step by step with you and maintain the pace. I hope the pace is fine so that, we are working things together. Okay, now finally, we're going to work on the step number 7 as well, and which is making the consolidated balance sheet. Now, when you're going to make the consolidated balance sheet, you've got one very crucial inputs, and that is the extract balance sheet. So very nicely handled, very appreciated. Thank you so much indeed. That's so sweet of you. Okay, now as we make that consolidated balance sheet, in this particular case now, we need to consider the information from the extract balance sheet and we'll then incorporate the data. So I'm just going to make one column for the parent company. Let's make a column for the holding. Let's make a column for the subsidiary. And let's make a column for adjustments, if any, and so that we can get the total column as well. And that's give us the information. It's a good idea that first of all, you copy the format of the consolidated balance sheet from the question itself and then proceed. That would be a better idea. So let me do one thing. Let's pick up the information. So we've got NCA. So let's take the non-current assets in which we've got the PPE and we also got the goodwill. The investments in any case will not appear in the console. Then there is current assets inventory. So we've got the current assets inventory. Then there is trade receivables. Then there is cash. So I'm just copying the information from the extract balance sheet. And then on the equity side, we can consider equity and liabilities. So we've got equity, and in this equity, we've got a couple of items to be taken. Would you like to tell me what are the items to be taken apart from the equity share capital? What will you take in the other equity? So in the meantime, let me just highlight the non-current assets and the current assets, equity and the liabilities highlighted as well. And in the exam, such consolidated balance sheet is allowed on making notes and then the balance sheet, please confirm. Well, you can definitely make these columns because I think that's exactly we do in terms of the practical world as well. So I think it's a good idea that you make these columns. I think it's absolutely great to do that. Okay. That's right. In the other equity, you're rightly given, we're going to consider retained earnings, we're going to consider share premium, and we're also going to consider another important element, and that is NCI. Because when you consider the other equity, you also need to consider the last item as NCI. And there is non-current liability and current liability. So we'll take the non-current liabilities. And we've got the current liabilities as well. In the current liabilities, we'll also include DC, lest we forget. So I think now it's time to pick up the information from the question and fit it across. Yes, because 1 year is pending, so that becomes the case. Wonderful indeed. Okay, super. So now let's go back to the extract balance sheet, pick up the information. I guess PPE, there was nothing in the extract balance sheet. So I think it remains at 5,500. And as far as the subsidiary is concerned, it is appearing at 1,500. Anything else to be taken in the PPE? So in terms of the property, plant, equipment, the further adjustments to be taken, yes, that would be the fair value adjustments, additional depreciations, great. So I think the fair value adjustment was to the extent of 200 and the additional depreciation was 80, I guess. That's correct. So with this, we can get the information. So let's get the total under this case. And as far as the goodwill is concerned, go back and the goodwill is appearing to the extent of 1032. That's picked up from the steps. Then we go to the inventory. Inventories are given 550 and 100. So this is 550, this is 100. There are no stock reserve adjustments, anything else is given. So just take the sum total of this. Same goes for the trade receivables as well. So that is 400 and 200. I am not given any further information. No intercompany owings, no adjustments taken. And that's correct. And that's right. So then we consider the cash as well. The cash is 250. No adjustments in the cash as well. And this takes care of the status. So now we can get the total of the asset side of the balance sheet as well. So this gives me 9652. Super. Okay, now we consider the equity share capital. Would you like to tell me where should I pick up the equity share capital? We need to consider only the parent company. Subsidiary share capital never appears in the balance sheet. So what is the place you're going to pick up that information from? And that's right, that's what I wanted to hear. Extract balance sheet, we're going to pick up the information. So I think from the extract balance sheet, if you look at the share capital, so let's go back. So the extract balance sheet is 2200. So let's fit it out here, 2200. Retained earnings and share premium is going to be picked up from which place? In the meantime, let me take the NCI. The NCI is to the extent of 347.4. So NCI is 347.4. And where do we pick up the information from? The RE as well as the share premium? That's absolutely correct. Step number 6, that's what I wanted to hear. So this is 1190.85. This is 1190.85 and the share premium is 160. Okay, that's wonderful indeed. So this is done. So I like the teaching why Excel is very nice than the other method, because this Excel will be available for revision as well as the board studies. Of course, I thought, as I do the practical illustrations, it's a good idea to do it in the Excel sheet. It gives you the entire workings in a go. That's what I thought as much. No worries. We're going to use the Excel in the next 2 classes as well, so that all the data is there with you instead of using a normal book. Wonderful indeed. Okay, then we go to the non-current liabilities, and in terms of the non-current liability, it is 3000 and it is 400. So non-current liabilities is 3000 and that is 400. I guess there are no adjustments given, and that's going to fit in out here. And then we can take the current liabilities, that's extract balance sheet, right? So current liabilities, we can take 650, of course, for the parent subsidiary. But let's go to the extract balance sheet to pick up the parent's current liability. So I think we have the DC, and I think the DC is 453.75. Right, so I think we can get that information. So this is going to be 1250 plus 453.75. Was it 453.75, right? Let me just go back to the extract balance sheet. Yes, it was 453.75 plus 1250. So this comes to 1703.75. I think that's it. Nothing else is to be taken. I guess all the adjustments, everything is done. Hopefully, the balance sheet should get tallied. Let's see if it is agreed or not. Wow, we got the answer 9652. The balance sheet is agreed. Wonderful indeed. That means we've done the calculations absolutely correct indeed. I know we've taken almost 1 hour to do the question, but that was, with explanations going slow and steady. Otherwise, I think you can decently do it in around, I would say, 45 minutes time. Wonderful indeed. That was not a very tough question, but if you technically ask me, if you look at the past examination questions, I think this is one of, you can say, the technical questions which have come in the examination so far. If you look at this, though, one can go on a trail of more complicated questions as well, but this is, one of the kind of toughest questions available so far. Wonderful indeed. Okay, so far so good. Now I think let's take it further. So I am now going to go to the next area that is on the chain holding. Let's share now another question to you, and we are now doing a question on a chain holding. We'll go step by step on that case. Sir, a possible mind map on the dividends in the question. I'm confused at the time of dividends. Okay, if you remember in the previous class also, I just made a mind map, and I think I'll just like to reiterate that point once again. That if you are given a dividend in the question, my inputs would be that in step number 2B, I'm saying in step number 2B, you should organize the net assets before deducting dividends and the net assets after deducting dividend. So when you do the analysis in terms of step number 2A, you should reduce the amount of dividends to get what is still available. That's one thing. But when you get the step number 2B, my advice in terms of step number 2B is that you should get two net assets. One is the net assets without dividend, and one is the net assets after dividend. Now, when you calculate the goodwill, you need the net assets without dividend. When you calculate the NCI, you need the net assets after dividend. Because when you calculate the goodwill, it is a calculation on the consolidated balance sheet date. And it is on the date of acquisition. But when you calculate the NCI, it is on the balance sheet date. So I give that note as well, that when you're calculating NCI, you're focusing on the balance sheet date. So you need the net assets after dividend. When you're calculating the goodwill, the focus is acquisition date. So you need the net assets without reducing dividends. Right? I hope you got the point. I've taken that in mind map. It's there in the Excel sheet as well. I'm going to put that summary in the Excel sheet also in the last class, where I've just made a point that the two net assets required, which one is needed for the NCI and which one is needed for the goodwill. I hope that'll help. Okay, so far so good. Now let's go further. Let's now go to the question on a chain holding. Now, this question number 13 is also an examination question. It came in November 2018, and that was for 16 marks. A similar number 14 also came in the exams, and this was in July 21, 16 marks. Almost quite a similar question indeed. So we're going to do the question number 13 with you. Let's have a read on the inputs in terms of question 30. So we are given, prepare a consolidated balance sheet as on 31st March 18 for a group of companies comprising Usha, Nisha, and Sandhya. So we're given the balance sheets of all these three companies. And then it says in the additional information, Usha has got 80% shares in Nisha. And Nisha has got 75% shares in Sandhya. So it's like a chain. Usha has got shares in Nisha. Nisha has got shares in Sandhya. The holdings were all acquired on 30th September. It says 17. And then it says the business activities of all the companies are not seasonal in nature. So when it says they are not seasonal in nature, you can comfortably assume that the profits are earned evenly throughout the year. And that's what it says. Assume that the profits earned are earned evenly throughout the year itself. Then he says on 1st April 17, the following balances stood in the books of Nisha as well as in the books of Sandhya. Then he says 5 lakh is included in the inventory of Nisha, and this is purchased from Sandhya. Now we need to see what kind of transaction is this. So we're given Nisha is supposed to be the middle company and Sandhya is supposed to be the bottom company. And when it says in the point number 4 that inventory in Nisha includes which is purchased from Sandhya. So would you like to tell me, is it upstream or downstream in nature? Though I think I've given you the hint already. So this is supposed to be downstream or upstream. That's right, it becomes upstream in nature. Then he says the parent company adopted the accounting policy to measure the NCI at a fair value as per Index 103. And it says assume market prices of Nisha Sandhya same as the respective face value. So we're considering the face value and the market value of the shares in this particular case is the same. I think the point number 6 is something which you can ignore because this is something which is not technically should have been given in the question. So I think this is something which can be ignored, though it was a part of the initial, part of the question of the exam. Then he says analysis of profits and the notes to accounts must be a part of your answer. Okay, so I guess what we need to do now in this particular case, since it is a case of chain holding, it is basically making everything in a double. You need to do two analysis, you need to get two net assets, you need to get two NCIs, you need to get two goodwills. Everything is going to become double because there are two subsidiaries in this particular case. So I think let's begin the journey. So I'm just going to add the question number 30. And sometimes the good advantage you get in terms of using an Excel is you can do a lot of cut, copy, paste as well. Just copy and paste. So like for example, if you want to do the analysis in this case, you can actually do that as well. I love the Excel for these reasons as well, that it gives you that added advantage of doing that. Anyway, I think I run that advantage at this stage. You do not get that advantage at this stage. Okay, so I think let's begin. So we don't see that there is any kind of omissions which are given in the question. So I think there is no focus in terms of making any extract balance sheet. But now we know that everything is doubled because there are two subsidiaries in this particular case. So let's start with the step number 1, which is getting the date of acquisition and the percentage. So let's organize the data. So I think let's look at the date of acquisition and the percentage. And I think we need to do this in terms of the two companies separately. So I guess the two companies, one is Nisha and one is Sandhya. So we've got Nisha and we've got Sandhya. So these are the two companies in which we need to get the percentages. Usha is got in Nisha and Nisha is got in Sandhya. So let's, I think, identify the percentages. So if you look at the balance sheet in the question, so we're given that Usha has got 16 lakh shares in Nisha. And if you look at the total capital in the balance sheet of Nisha, it is appearing at 200 with the shares of 10 each. So we can say the number of shares is 20 lakhs and we've got 16 lakh shares. So 16 by 20, I think that works out at 80%. Similarly, we can go to Sandhya as well. So Sandhya, there are 12 lakh shares. The share capital in Sandhya is appearing at 160. There is 16 lakh share. So we've got 12 out of 16. 12 out of 16, I think that works out at 75%. And I think for the date of acquisition, we are clearly given in the point number 1. So this percentage was very clearly given in the point number 1. I computed that as well. So shares are all acquired on 30th September 17. This is 30th September 2017. Both are 30th September 2017. Okay, so that's, I think, not a big deal. Getting the acquisition date and the percentage is a simple affair. Now let's go to the step number 2A, and we need analysis of equity. So I think it's a good idea now, again, asking you a few questions. Tell me how many focus points are there with you in step number 2A. So what is the number of focus points as we decided in this particular step? Yes, one is the three focus points. That's correct. One is we need to consider the other equity of the subsidiary, good. One is the fair value adjustments, good. And one is upstream. I think tonight, as you go to sleep as well, you will hear my voice telling you that there are three focus points in terms of analysis of other equity. Wonderful. So this is, it should be very crystal clear in the back of the mind. As you proceed, your mind needs to be very focused on that. Super. So let's, I think, first of all, make the chart, because once you're working this out, you need to first make your columns pre and post acquisition, organize the data, and now we need to do two analysis as well, because we've got two subsidiaries in this case. So even at the examination, we're going to hear your voice. Absolutely. I'm pretty confident on that. Okay, so I think let's begin with the analysis of Nisha. So we'll make two analyses. One is analysis of Nisha. Let's create the columns. And let's also consider the analysis of Sandhya. So let's organize the pre and the post acquisition as well. So this is going to be particulars. And this is going to be pre-acquisition. This is going to be post-acquisition. Again, we consider this as particulars. And you organize the pre-acquisition and organize the post-acquisition as well. Define this as pre-30th September 2017. And this is from the date of acquisition to, and what is my balance sheet date in this case? My balance sheet is on March 18, so only 1 year, not even 1 year, I would say it is 6 months that becomes post acquisition. So I think we can copy this for the other company as well, because the acquisition date, everything is absolutely common. So let's put this across as well. So whenever you do the analysis, it's always a good exercise that you should define very clearly what is pre and what is post acquisition. Date wise, we define the same. Now let's go to the further inputs. So what we're going to do in this particular case, we are first going to look at the other equity in the balance sheet of the company. Let's go to the balance sheet. Now, in the balance sheet of Nisha, as well as in the balance sheet of Sandhya, I think what we're given is two inputs in this particular case, reserves as well as retained earnings. So I think we need to take care of both the inputs in this case. So I think let's begin with the reserves of 50. Let's go to the additional information. And we're given in the point number 3. Now remember, this reserves and retained earnings is not given to me on the date of acquisition. This is given to me as at the beginning of the year. So reserves at the beginning is 40 and reserves at the end of the year is 50. Would you like to tell me what is pre and what is post? 40 is the balance at the beginning and 50 is the balance at the end. Remember, 40 is not the balance on the date of acquisition. So would you like to tell me how much is pre? Wonderful. So you'll divide 40 as pre and the increase of 10 will be divided in the time ratio. Very good. So I think we can consider the reserves. So this is going to be 40 and I think I'll divide the current year That's in the time ratio. So we divide this in the time ratio. So this is going to be 5. And you know what you need to do in this particular case? In the post-acquisition column, you should get into the habit of segregating the reserves and the retained earning. Because when you're going to consider the share in the post-acquisition, you need a line-to-line addition. So it's a good exercise that in the post-acquisition reserves, you should split a column for reserves as well as RE. So you can clearly see the reserves and the RE. Okay, so this is done. Now let's go to the retained earnings. A similar kind of calculations will be done. Retained earnings in the balance sheet is given to me 25, and the retained earnings at the beginning of the year is 10. So would you like to tell me that what is pre and post? The 10 undoubtedly is pre. So what about that increase of 15? Is that increase of 15 also going to be divided in the time ratio? 10 is pre, that's right. And then we can say the increase of 15 is divided in the time ratio. Super. So let's take the figure which is current year. So I'll take the current year. This will be divided in the time ratio. So we go systematically. This is going to be 7.5. And when you consider this, please consider a separate column for the retained earnings. So we're adding, you can see separately both the figures. That's right. The figure of reserves is taken in a separate column. The figures of RE is taken in a separate column altogether. Super. So I think this is done. Am I given any fair value adjustments in the question? No, I'm not given any fair value adjustments. Is there any stock reserve which is upstream in nature? But yes, but that's in this analysis of Sandhya. Because the profit was made by Sandhya. Sandhya made a sale to Nisha. So we need to take care of that. Correct. So I think right now the analysis is done. We can get the sum total of this. So this is 62.5. And this comes to 5. And this works out at 7.5. Right, so I think with this inputs in hand, we can highlight this portion. Now I think we need to do the analysis of Sandhya absolutely in the similar lines. The only additional thing is the stock reserve rest absolutely similar in nature. Let's, I think, begin with the reserves in this case as well. So I think let me do one thing. In the post-acquisition, let's take the column for reserves and let's take the column for retained earnings as well. Okay, so I think let's begin the analysis with reserves in this case. Let's go back to the balance sheet. Reserves are appearing to the extent of 40 for Sandhya in the balance sheet, and in the additional information, it is 30. So I think you can tell me how much is pre. That's right. 30 is pre, and the increase of 10 again divided in the time ratio. Wonderful. So we can say 30 becomes pre, and we can take the current year in the time ratio exactly the way we did earlier. So this is going to be 5, and this is going to be 5. Similarly, we can go for the analysis of RE as well. The RE is appearing in the balance sheet at 30, and we're given the RE in the additional information is 15. So I think you can easily define that 15 becomes pre-acquisition, good, and the increase that is in the time ratio. So 15 is pre, and the increase 15 in the time ratio. So 15 becomes pre, and the current year that would be in the time ratio, and this works out at 7.5. This is pre, and this is going to be 7.5, that is post as well. Wow. And I think least we forget, we also need to consider the stock reserve, which is upstream in nature. By the way, would you like to tell me that the stock reserve is going to be adjusted out of which particular portion? Are you going to make a reduction in terms of reserves or in terms of RE? The elimination of stock reserve is going to be done in the retained earnings in the post acquisition. Very good. So let's come back on the calculation of the stock reserve, which is given in the point number 4. It says 5 lakh is included in the inventory and this is purchased as cost plus 25%. So when I say cost plus 25% would mean 1/4 on cost and it is supposed to be 1/5 on sale. So on 5 lakh, the stock reserve is 1 lakh, but we need to be careful. The figures we have taken is all, I guess, in terms of lakhs. So I guess we need to consider the stock reserve is 1. The figures are in lakhs of rupee. So we need to eliminate this stock reserve from the RE, that is 1. I think that's done. So we get the analysis of the profits. This is 57.5. This works out at 5. And similarly, we can get this information as well. And that works out at 6.5. So we can easily get the additions. Right. So I think two analysis that makes the question, a little more, time consuming, because you are having given 2 subsidiaries. So everything is getting doubled in this case. Now let's go to the step number 2B, and that is the calculation of the net assets. That is on the date of acquisition. Similar calculations would apply in this case as well, both the companies. So I think we'll do one column for Nisha and we'll take one column for Sandhya. So we know that the net assets is going to be a sum total of the equity share capital and we add the pre-acquisition equity, which is available from the analysis. Now, as far as the equity share capital is concerned, you can go back to the balance sheet. So equity share capital for Nisha and Sandhya is appearing at 200 and 160. So this is 200 and this is 160. And the pre-acquisition equity you can pick up from the analysis, that is 62.5 and this is 57.5. Right, I guess my step number 2B is also done. We get the sum total of this. Step number 2B is done. Okay, then we go on to the step number 3, and the step number 3 is in terms of calculating the purchase consideration. Now comes the crucial step, which I did not rectify in the initial. Now it is time to go back to the step number 1. Tell me why. When you're calculating the purchase consideration, it's time to revisit and there is a need to make some changes in the step number 1. Would you like to tell me what? Let me, I think, put the question differently. And that's right. I think I got the answer. Very good. Can I say in terms of the chain holding, the consolidation will always be done from the point of view of the top company, which in this particular case is, I guess, the top company's name, I guess, is Usha. So can I say we need the percentage Usha has got in Nisha, we need the percentage Usha has got in Sandhya. So what we need to do in this particular case, this percentage which we have identified is the percentage Usha has got in Sandhya. This is Usha in Sandhya. Sorry, not Usha in Sandhya, sorry. It is Nisha in Sandhya. But what we need is the effective percentage. And that effective percentage is what Usha has in Sandhya. So would you like to tell me what is the effective percentage Usha has got in terms of Sandhya? Because that will decide my consolidation percentage. And that's right, it works out at 60% because you got 80% in Nisha. So we can say we've got 80% of 75%. So when you take 80% of 75%, it works out at 60%. So this is one small little exercise which you can do when it comes to a chain holding, because everything, the consolidation will be done from the point of view of the top company. So you need to see Usha and Nisha, and you need to see Usha and Sandhya on an effective percentage as well. That's wonderful indeed. Now with this we come to the purchase consideration. I am given the investment in Nisha. I am given the investment in Sandhya. This is by Usha, and can I say this is by Nisha? But we need to convert it. We need to convert it into, can I say, by Usha. So this is what we need to do. We know that this is the percentages, the purchase consideration. So let's see Nisha by Usha. So I guess we can see the investment. Usha has got in Nisha 170. Usha has got in Nisha 170. Usha has got in the other company, Nisha has got is 140. So this is 140, but we need in terms of Usha. So can I say 140 into what? Tell me, 60 or 80%? What are you going to consider? 140 into 60 or 80%? That's right, because we got 80% stake in the company, so you need to consider 80%. So let's see what is the 80% figure comes to. So 140 into 80% is 112. That converts the data on the effective percentage. Okay, that's superb indeed. Now we go on to the next step, that is step number 4. Step number 4 is the calculation of the NCI. We need two NCIs again. And I would say in terms of chain holding, it's a good idea that you calculate the NCI and you calculate the goodwill, I think on simultaneous level. I think it'll be a good exercise that you make your presentation. So let's at least organize all the structure. Let's see the structure in terms of NCI as well as in terms of goodwill. So let's do one thing. We've got NCI in Nisha. We've got NCI in Sandhya based on the effective percentages, of course. So I'm just writing the data, NCI on date of acquisition, add the share in post acquisition. Let's go to the step number 5, that is on the goodwill calculation. We're just organizing the information so we can see the inputs clearly. So we need for Nisha, we need for Sandhya. Let's organize the input. So this is going to be purchase consideration. Add NCI on date of acquisition. We take the NCI on date of acquisition. Then we consider less net assets on date of acquisition. Okay, I think now once we get the structure, now we need to be careful. We need to be organizing all this information. So now I'll put across the inputs to you, and I think you can help me in terms of these calculations. Okay, I think let's begin with the informations in this particular case. Let's, I think, first of all, go to the NCI. So I think for the NCI, we are given something in the additional information. It says the parent company in point number 5, the parent company adopted an accounting policy to measure the NCI. It says market prices of Nisha and Sandhya same as the face value. So we can say the equity share capital in the balance sheet, which represents the face value itself, represents the market quotation itself. So would you like to tell me what is the NCI on the date of acquisition? Can I take the share capital into the respective percentages? 200 into 20%, can I do that? And what about that 160? 160 into what percentage? That's right, 200 we can take 20%, but what about that 160? So we're going to consider 160 into what percentage? That's right, 40%. 60% belongs to the parent, so we can say 40% is the effective percentage of the NCI. Good. So let's go back. So we can say the NCI out here, this is 200 into 20%. That works out at 40. And this is 160 into 40% NCI. I think that works out at 64. And then we consider the post-acquisition profits in step number 2B, step number 2A. I guess the post-acquisition is 5 and 7.5 because we've got reserves, we've got RE. So 5 and 7.5, it's 12.5 into 20%. Then let's go to Sandhya. Sandhya is 5 and 6.5. So 5 and 6.5. So we can consider that is 11.5. So let's put it 11.5 into 40%. That'll give us the post-acquisition. 12.5 into 20%. That's 2.5. And this is 11.5 into 40%. That's 4.6. Okay, is there any other things which needs to be adjusted at this particular stage? Am I supposed to make any other adjustments in NCI? Because let me remind you, when you go to consider the purchase consideration in terms of Sandhya, you are going to consider 112. You're going to consider this as 112. This is the effective percentage. So would you like to tell me, is what do you do with that remaining 40%? The question indirectly is, you took 80% of 140. In the calculation of the PC, you're taking 80% of 140. So where does that remaining 20% go? What do you say? Because 80% goes in the calculation of the goodwill, then where do we take the remaining? And that's rightly said, we need to reduce the NCI of Nisha by the same 20%. That's correct. I hope you remember the logic as well. Then why are we reducing this? Because when you are not going to take the 20%, it appears in the balance sheet, and this is the money which is funded, because 80% is funded by the parent, 20% is funded by the NCI. So when you're not going to consider 20% of the investment that would appear in the balance sheet, so the 20% funding by the NCI, we're netting it off with the NCI. So what we need to do in terms of NCI is make a reduction. So out of that 140, we need to consider the remaining 20%. That's 28. So I'll put it as less. This is set off. We are setting off this against the NCI. So this is another crucial point which we need to take care in terms of NCI. So let's see the total. This is 14.5. And let's take the total. This is 68.6. And I think let's get the sum total of the NCI as well. This is a total of 83.1. Because in the consolidated balance sheet, we will be reflecting the total NCI as well. Okay, let's proceed further. Now let's go to the calculation of goodwill. So we can see that I've already taken the PC to the extent of 80%. So what was the PC in Nisha? PC Nisha is 170. NCI on the date of acquisition, you can pick up 40 and 64. So we can get the total. This is 210. We can get this total. This is 176. And net assets on the date of acquisition, step number 2B, 262.5. 262.5. And this is 217.5. So let me put this in brackets as well, 262.5. So I think we are getting capital reserve in this case. In both the cases, we are getting a capital reserve. So this is capital reserve. And this will also go in the balance sheet as other equity only. And I think let's add this up. I guess if you take the sum total of this, the capital reserve is appearing at 94. Wow. Step number 5 is also done. Now we are ready to go to the step number 6. So let's go to the step number 6. And what is the step number 6? Consolidated balance sheet, and that is other equity in this particular case. Tell me now how many focus points are there in terms of consolidated balance sheet other equity. I think I gave you that there are how many focus points in this case. So would you like to tell me that when you prepare the consolidated balance sheet other equity, how many focus points are you going to consider in this particular case? And that's right, 3 focus points. We need to consider the share in post-acquisition. We need to consider the goodwill impairment, and we need to consider the stock reserve, which is downstream in nature. Super. Now we need to consider for both the companies now, so we need to be careful. So I think let's consider there is reserves, and let's consider there is RE, because the parent company has got reserves and RE. So let's take the holding company's own reserve. So holding company's own reserve is 90 and retained earnings is 80. So this is 90 and this is 80. Let's add the share in post-acquisition. So let's go to the post-acquisition. Reserve in reserve, RE in RE. You need to go line to line addition. So we know the reserves is 5. And it is 7.5 RE. Reserve is 5 and RE is 6.5. So we need to go separately. So let's take this in terms of Nisha, in terms of Sandhya. So can I say in terms of Nisha, the reserve was 5 into 80%. Very carefully. RE is 7.5 into 80%. And can I say in terms of Sandhya, it is 5 into what percentage? As far as Sandhya is concerned, 75, or are you going to consider 60%? That's right. So we need to consider 60%. And this is 6.5 into 60% again. Okay, so this is the post-acquisition. I guess this is 4. This is 3. 7.5 into 80%, this is 6. 6.5 into 60%, and I think that's 3.9. The post acquisition is done. So, was there any goodwill impairments? I don't think so. Was there any kind of stock reserve downstream? No. So, I think this is it. That's all what is done. Let's take the sum total. And you can do another thing as well, because this is the other equity. So, in the other equity, you can even show the capital reserve column as well. So you can even create a capital reserve column, which is to the extent of 94, because this 94 is also a part of the other equity in the consolidated balance sheet. So I think we can do one thing. Let's add up all this information. So this can also give you the sum total of the other equity in the consolidated balance sheet as well. Wow. Now I think we're in a comfortable position making the consolidated balance sheet as well. So let's go to the step number 7, that is consolidated balance sheet. Now we need to be careful further, because now we need to consolidate how many balance sheets put together. So would you like to tell me how many balance sheets are going to consolidate put together in this case? That's right, 3. The parent company Usha and the subsidiary Nisha and Sandhya. So let's take a column for Usha. Let's take a column for Nisha. Let's take a column for Sandhya. And let's take a column for adjustments, if any. And let's take a total column as well. Okay, so I think let's begin the data. I think what we're going to do, first of all, copy the balance sheet from the question itself and then proceed. So the question came long time back when the format was not in accordance with the Schedule 3 Division 2. The format was given based on a Division 1, but we're going to make a Division 2 balance sheet only. So let's take on the asset side NCA. So we take the assets. We got NCA, and within this NCA, we've got tangible assets. The investments will not appear in the balance sheet, of course. And that's it. There's nothing else out here. Then we can show the current assets. Current assets, we've got cash, bill receivable, trade receivable. Cash, bill receivable, trade receivable. Then there is inventory. So this is on the asset side, just highlighting the information, non-current and current assets. Then let's consider the equity and liability side as well. So we've got equity. So we've got equity share capital. Then we've got other equity. So I have the total. Otherwise, you can show reserves. You can show retained earnings. And you can also show capital reserve, NCI, just putting the information together. They've taken the sum total. And then I guess we given on the liabilities, there are no non-current liabilities given. So non-current liabilities are not there. Then we given the current liabilities. And I guess on the current liabilities, trade payables, bills payable, some intercompany owings are there, trades payable and bills payable. Right, so I think this is done. Now let's pick up the information and start. Okay, so I think the only thing which I see in the additional information, I guess, is to the extent of stock reserve. There's nothing else, or there is intercompany owings in a balance sheet. Let's begin. So I think the tangible assets 160. This is 160. This is 180. And this is 150. No adjustments, no fair value adjustments, nothing. It comes to 490. Then there is no goodwill. So let's take the cash. This is 114 2020. 114 2020. No adjustments available. Then let's take the bill receivable 36. And this is there any intercompany owings on the bill receivable front? If you look at the liability side on the bills payable, do you see the bills payable Usha is 35 and Sandhya is 15? Can I say that makes it intercompany owings? Can I say to the extent of 50? Correct. So let's take the bill receivable 36 and 15. This is 36, this is 15, and intercompany owings is 50. So we cancel the intercompany owings. This works out at 1. Trade receivable is 130, 50, 130, then it is 50, and it is 110. So 130, 50, 110. And any intercompany owings on the trade receivables? I don't think so. Then there is inventories. Inventories are given, it's 110, 35, 25. 110, 35, 25. And I think there was a stock reserve to the extent of 1. So that stock reserve gets eliminated from the inventory. Done. Okay, so I think this is on the asset side, I guess. So we get the total as 1104. Let's go to the liability side now. Equity share capital will be only for the parent company, and that's to the extent of 300. You can copy the inputs from step 6. 97, reserves is 97, and RE is 89.9, capital reserve is 94. So 97, 89.9, and 94. And what about the NCI? NCI was 83.1 from the step above. There are no non-current liabilities, I guess. I'm not given any non-current liabilities. Then finally, trades payable is 235, 115. Trade payable is 235. It is 115. And the trades payable is 90. So this works out at 90. And there is no intercompany owings on the trades payable. We take it as it is. Then bills payable, this is 15 and 35. This is 15, this is 35. Intercompany owings cancelled is 50. What we did in bill receivables and the bills payable, this becomes 0. I guess hopefully the balance sheet should get tallied, I guess. Let's see, the balance sheet is tallied. Wow, 11014, 1104. The balance sheet is agreed on this basis. Wonderful indeed. Okay, so this takes care of the inputs in terms of the chain holdings as well. I think we've done a good number of questions on 110. It's time to do some questions on 28. And I'm keenly interested in doing that, question on Indus 28, which is based on the calculations of that appendix. You want me to do that question, I guess? as a revision because I think that's one of the most typical technical question which is there. Or you want me to do some of the questions, or you want me to do the appendix question? The choice is yours. I'll go completely with your choice on that. So, what do you say, friends? You want me to do the question? I'll show you that question as well. I put that question in the assignment as well. So, this is the question, question number 20, which is in the appendix to Index 28. You want me to do this question? Otherwise, I'll do other questions. If you want me to do this question, then I'll do this question. Any inputs? Any opinions? Okay, maybe you can decide that in the break, I guess. Then accordingly, we take a call on this. Okay, I think I got some inputs. So I didn't get that. You mean we do that question right? You want me to do that question correct from the assignment? You want me to do that question which I showed you? Okay, wonderful indeed. So I think let's take a break at this stage. Let's relax the minds. 10, 12 minutes. I'll be back and then we'll start with a beautiful question on Index 28 as well. Right, friends, we take a break. Enjoy your break. Okay, thank you. Welcome back, friends. I hope you had a relaxation of mind. And now we're going to do another very interesting question, which is on Indus 28. Technically, if you put a name, it is called other long-term interest in an associate as well as a joint venture. Now, this is a little typical kind of question, and generally people tend to go wrong. So, what we're going to do, we're going to solve this on a step-by-step basis so that you do not make any mistake in this kind of a question. I think let me also come to the point of equity method after that, but I think first I'm going to directly go to the that particular question with you. So let me share the question to you. We're looking at the question number 20. It says an entity has the following three types of interest in an associate. So we're given that they've got equity share, they've got preference shares, and they've got long-term loan. Now, since you know the concept, I think some quick questions would be great to ask you at this stage. And I think that will be a wonderful exercise. Can you tell me that when a company has got investment in an associate, I'm looking at a standalone financial statements. Can I say, as far as equity share is concerned, in this particular case, would you be okay? Rather, let's talk about preference shares and long-term loan. I'm looking at the standalone financial statements. So, can you tell me, would the investment in preference shares and long-term loan will they be accounted under Index 109? Yes or no? As an investor, you've got other than equity shares, preference shares, long-term loans in an associate company. So in these standalone financials, would they be covered under Index 109? What do you say? Yes or no? Though the answer is already given on the right hand side, but I think on a safe side, I'm still putting that question across to you. It says the non-cumulative preference shares is a part of net investments and they are measured at a fair value as per Index 109. So undoubtedly, this is covered under 109. Then he says the loan is carrying interest at 10%. The interest is received at the end of each year and it is accounted at the amortized cost as per Index 109. And this also forms part of the net investment in the associate. Now, the interesting part is that these are accounted under Index 109 based on the standalone financials, and it says they are a part of the net investment, which means these preference shares or these long-term loans are not going to be repaid in the near future. And if they're not going to be repaid in the near future, that makes it a fit case that, this is other long-term interest in the associate. Then he says at the start of the year, the carrying value of each of the above interest is given. So we're given this is the balances at the start of the year, equity shares, preference shares, and loan. And then it says the following table summarizes the changes in the fair value of the preference shares as per 109 and the impairment loss on the long-term loan again as per 109. Now, as far as the preference shares are concerned, they are accounted, you can say, at a fair value. So fair value changes are defined. As far as the long-term loan is concerned, it is accounted at AC. So we're given the impairment loss. And we're also given the share of the investor in the associate profit or loss for a period of 5 years. Then he says throughout a period of 1 to 5, there is no objective evidence of impairment in the net investment in the associate. The entity does not have any legal or constructive obligation to share the losses beyond the interest in the associate. We need to determine the closing balance of each of the above interest at the end of each of the year. So the requirement of the question is to calculate the investment values in these shares at the end of each year. Now let's go step by step. I will be needing your inputs in between as well, but let's begin a journey step by step. So we are on question number 20. So at the first instance, what we need to do, let's organize a column for all these investments. The first thing we're going to do, organize a column for all these investment. So we've got equity shares, preference shares. Let's put down equity shares. Let's put down preference shares. And let's put down long-term loans. So this is the status of the three categories of investments: equity share, preference shares, and loan. Let's also note down the balances at the beginning. So we have the balance, you can say, at the beginning of year one. So let's note down the balances at the beginning of year one as well. And now let's proceed. So let me note down the balances. It works out at 10 lakh, 5 lakh, and 3 lakh. So this is 10 lakh. This is 5 lakhs. And this is supposed to be 3 lakh. So just note down the investments value, which is given at the start of the year. Now, what do you need to do on a very careful level? I think let me put this across as well. Step number 1. Now, in this particular case, what you need to do, you need to incorporate the aspects of Ind AS 109. In step number 1, you need to see wherever Ind AS 109 needs to be applied. Quick question to you. Is the equity share accounted under 109? When you make an investment in a related party, is that investment covered under the purview of 109? What do you say, yes or no? And that's rightly said, of course, no. So can I say this investment in this 109 is not applicable? So in terms of preference shares, I need to consider whatever is the fair value change. In the year number 1, we're given there is a fair value decrease to the extent of 50,000. So let's book the decrease to the extent of 50,000. And the long-term loans, we need to consider the impairment loss. In the first year, there is a 50,000 impairment loss. Let's also book the impairment loss in this case. So in step number 1, you need to account for these investments under 109, leaving the equity shares. All other investments are accounted under 109. So let's get the values post the, let's get the values which is post 109. And when you get these value, this still remains at 10 lakh. This becomes 4.5 lakhs. And this becomes 2.5 lakh. So it's as simple as that, that your step number 1 is simply applying Ind AS 109. Now comes the step number 2. And step number 2 is applying Ind AS 28, which is on the equity method. Now, let's go back to the information. In the first year, there is a investor share in the losses to the extent of 16 lakh. Now, the problem is that equity investment is appearing to the extent of 10 lakh. And the share in profits, or you can say the share in losses, is to the extent of 16 lakh. So can I say I can pass on only 10 lakh rupees of loss? Tell me, what do I do with the remaining 6 lakh? Because 16 lakhs is the total share in loss, out of which you have allocated 10 lakhs of loss. There is 6 lakhs of loss which cannot be allocated to equity. Do I pass it on to the preference as well as the long-term loan? And if yes, can you tell me, are you going to first give the loss to preference, or are you going to give the loss to the long-term loan? Remember, once the company is going to liquidate, can I say first the losses will be given to the, you can say first the losses will be borne by the preference, and then you can say it is going to be borne later by the long-term loan. So tell me, this 16 lakhs will be given to whom? Because when you're going to pay the money, let's say on liquidation, the lenders get the money, then the preference gets the money. And when you're going to give them the losses, the equity bears the loss first and then the preference. That's right. So can I say we will pass on out of that 6 lakh, we can pass on a loss of 4.5 lakhs to the preference, and the remaining 1.5 lakhs can be passed on to the loans. So let's get the values post the step number 2. This becomes 0, this becomes 0, and this becomes 1 lakh. So this comes to 1 lakh. Okay, so I think once we've done this, then I would say there is a need to go for a step number 3. Simple 3-step model. First, you apply Index 109, get the values. Then you apply Index 28, get the values. Then in step number 3, what you need to see is that is there any unabsorbed? Is there any unabsorbed losses in this case? Tell me, are we getting any unabsorbed losses in this particular case? I think we've already incorporated the entire 16 lakh. So can I say unabsorbed losses in this case is 0. But it'll be a good practice to note the unabsorbed losses at each stage as you proceed. I hope you got the 3-step model simple and straight indeed. Now let's go to the next year. So what I'm going to do, this was the calculations which was made in the year number 1. I think I can do one thing interesting indeed. I would just like to pick up this information and I'm just going to fit in this information, because I'll need this information chart as it is, and we'll be able to get the chart for the second year as well. Wow, I think that is a good exercise one can do on the Excel with all the information available. You can just copy and then paste. No worry, I'll go with you. I'm just taking the headings. The rest I'll fill up the data. That's not an issue. I've just taken the headings in this case. Okay, so let's begin. Yes, that is the beauty of Excel, which we can do. Now let's take the values which are there in step number 2, 0, 0, and 1 lakh. So the balance at the beginning of the second year. So this is the balance at the beginning of the second year. This is 0, this is 0, and I think this is 1 lakh. Okay, now once you get this information, I think we again go to the second year information. We're given the fair value change is 50,000 degrees. So let's put in the fair value change. So 50,000 is the fair value change again, but there is no impairment. But the problem now is a different one. There is no value of preference share which is there with us, and we want to pass on 50,000 as a fair value change. Now the problem is, since we had allocated a loss as per Ind AS 28, the value of the investment became nil. Otherwise, we would have conveniently given the loss of 50,000 to the preference share. So what do we do now? Since the value of the investment at the beginning of the second year is nil, you cannot pass on this 50,000. So what am I supposed to do at this stage? Let's get the course of action from your side. Because the preference shares in this case stand 0 because of allocation of the loss. We can move 50,000 loss to the long-term loan. No. At the first instance, what you need to do, the losses allocated under 28 will be reversed. So what we need to do in this particular case, we need to reverse the loss which was allocated under 28. In the previous year, we allocated the loss of 4.5 lakhs. So we need to reverse it to the extent of 50,000. So in this particular case, the reversal of 50,000 will happen. Once you pass on this loss of 50,000, reverse it back, then only we can allocate for. Right. So previous year, the losses allocated was 4.5 lakh. So what do you need to do? You need to reverse that 50,000 so the allocation can be done, which means that 50,000 loss stands unallocated. So let's make a note out here that there is an unallocated loss, which is to the extent of 50,000. Because of this reversal, there is a loss to the extent of 50,000, which is unallocated. So we'll keep a track of that. Let's now go further. So now let's see what is the amount of impairment loss. There is no impairment loss in this case. So can I say in this particular case, so we can get the values after this. This is 0 and this is 1 lakh. And this is, of course, remains at 0. So these are the values post the step number 1. So since the preference share was 0, we reversed the losses under Ind AS 28 so that we could allocate the fair value changes under Ind AS 109, and we made a note that there is an unallocated loss. Now let's go to Ind AS 28. Now in Ind AS 28, there is a 2 lakh rupees of loss. Now the question rises, for this 2 lakh rupees of loss, what do we do? Can I say, can I allocate anything to the equity? No. Can I allocate anything to the preference? No. Can I allocate this 1 lakh in terms of the long-term loan? Yes. But after allocating this 1 lakh, can you now tell me what is the total unabsorbed loss? Very carefully. So we had a loss of 2 lakh rupee. 1 lakh is gone to the long-term loan. So now what is the total unallocated loss? Out of 2 lakhs, 1 lakh stands allocated. So 1 lakh is still to be allocated, and there was a reversal of 50,000. So would you like to tell me what is the total unabsorbed loss? And that's right, absolutely. The total unabsorbed loss is 1 lakh 50. Correct. We can say this 1 lakh which could not be absorbed. So we can say 1 lakh which was not absorbed plus this 50,000, which is the unallocated loss out here. So your total unabsorbed losses is 1.5 lakhs. Okay, so I think this gives me the value post the step number 2, 0, 0, and 0. So this is the year number 2. So what we did in this particular case in the year number 2, since the amount of investment was 0, we had to reverse the losses allocated under 28. And then whatever unallocated losses of equity and the reversal of losses are there, it becomes an unabsorbed loss. And next year, you will have to allocate the loss of 1.5 lakhs again. Let's go to the year number 3. Let's pick up this information. Again, copy and paste. And let's go to the year number 3. This is year 3. This is balance at the beginning of year 3. Let's pick up the data. So first of all, the balances at the beginning of the year is 0 all throughout. It is 0 all throughout. There are no balances in the investment. So now let's go to the step number 1 in third year. Now in third year, there is a 1 lakh rupees of fair value gain. And there is 50,000 reversal of impairment loss. So we need to book a gain to the extent of 1 lakh in the fair value changes. We need to book a reversal of impairment loss to the extent of 50. So the values after 1090, then this is 1 lakh, then this is 50,000. Booking the fair value gains and booking the reversal of impairment loss, we get the values post the step number 1. Now let's go to the step number 2. What is the share in losses in the third year? There is no share in gain. There is no share in loss. But do we need to allocate anything in step number 2? Is there any losses which needs to be allocated in terms of the step number 2? Current year, there is no losses that we can see. But is there any previous unabsorbed losses which needs to be allocated in third year in step 2? And that's right, 1.5 lakhs is to be allocated. We cannot allocate anything towards equity. So we'll allocate this 1 lakh towards preference share, and we allocate this 50,000, which is towards long-term loan. So we can get the values post this 0, 0, and 0. Now, are there any unabsorbed losses after doing this? No. So we've got no unabsorbed losses after the allocation of this loss is done. So you need to continuously keep a track in terms of the unabsorbed losses like this. Because in this particular case, when you're doing this particular chart, if you keep a continuous track in terms of unabsorbed losses in step 3, your life is going to be simple. Now let's go to the year 4. Now in year 4, we know that there are no unabsorbed losses to be taken. So let's go for the year number 4. We again copy this out. So this is year number 4. This is balance at the beginning of year 4. And let's take the data. So balances in the previous year is all 0, 0, 0. So this is 0, this is 0, and this is 0. Now let's come back to 109. Now there is a fair value increase of 50, but no impairment or reversal. So 50,000 is the fair value change. So the value of the investment is 0, the value of the investment is 50,000, and the value of the investment is 0. Now we go to the Index 28. Now in the 4th year, there is a 10 lakhs of profit share. Now tell me, this 10 lakhs will be given to whom? Can I pass it on to the equity? Of course not. So what do we do with this? Should I distribute this losses first of all to whom? And that's right. First, we need to allocate the losses to the long-term loans, and then it will be distributed to the preference and then to the equity to the extent of the previous losses they bought. Good. So let's go back to the long-term loans and see how much losses have been allocated to them. I'm just going to mark this in red. Can I say in the first year, 4.5 lakhs, sorry, 1.5 lakhs was allocated to the long-term loan. Second year, 1 lakh was allocated to long-term loan, makes it what? 2.5. And third year, another 50,000 was allocated. So what is the total allocation so far? I guess is it 3 lakhs, if I'm right. So to the preference shares, you have allocated a total loss of 3 lakhs till date for all the years put together. Correct. So 3 lakh gets reversed on the long-term loans. Now let's go to the preference share. First year to the preference shares, you allocated 4.5. Second year, you reversed 0.5. That makes it 4. 4.5 lakhs. Reversal of 50 makes it 4. And third year, another 1. That makes it 5. So I think we allocated 5 lakhs. We allocated a total of 5 lakhs to the preference. That's right. So the reversal of 5 lakhs goes to them. Great. So now out of the total of 10 lakhs, can I say 2 lakhs is left over, which can be allocated to the equity shares. So let's get the values post the reversal. This is 2. This is 5.5. And this is 3. And is there any unabsorbed losses now in this particular case? No. There are no unabsorbed losses which we are having at this particular stage. Wonderful. Okay, now with this inputs in hand, we can now go to the year number 5 as well. Yes, now we are running profits in this case. That's wonderful. Now let's go on to the 5th year as well. So I think step by step, if you do the calculations, it is pretty simple and pretty straight indeed. So we are on year number 5. This is the balance at the beginning of year 5. And this is to the extent of 2 lakhs. So this works out at 2 lakhs. And this is to the extent of, I guess, 5.5 lakhs. and this is to the extent of 3 lakhs. And then we can again take the information further. So once we get this information, let's, I think, fit in the data further. Okay, so now we go to the next year as well. So in the next year now, we are given the information. There is a fair value change of 30,000. So let's take the fair value change. That is 30,000. There is no impairment, nothing. So the value becomes 2 lakhs. This becomes, I think, 5.8 lakhs. And this becomes 3 lakhs. And now we come to India's 28 as well. So now the preference share is 30. That's right. Equity is 10. Okay. So now we need to distribute the gain of 10 lakhs. So this 10 lakhs will go to whom? Is it going to go entirely to the equity shares in this case? Is my thought correct? Because preference and long-term loans, the entire losses given to them stands reversed. So can I simply pass on that entire 10 lakhs to the equity? Correct. So in terms of Indus 28, the entire 10 lakh goes to equity. So the value in this case becomes 12. This is, I guess, 5.8. And this is, I guess, 3 lakhs. So this gives me the figures which is post the reversal. And now, of course, we are not left with any amount of losses, which is to be taken in this case. Wonderful. So this is the treatment of other long-term interest as far as India's 28 is concerned. Right, friends. So I think that was simple and straight indeed. Now let's go further. Okay, I guess now what I want to do at this particular stage is give you some insights in terms of Indus 28, and we can do a practical illustration based on that as well. I got a little inputs that, instead of, sir, you giving me a mind map after the questions are done, you could do a little quick revisions of the concepts. And then after doing the concept revision, you do the questions on that. So I think that's well taken. So, what I'm going to do starting today only, and of course, in the next 2 sessions as well, what I'm going to do, I'll just take a quick recap of the concepts. And then based on the recap of the concepts, then we'll do questions and practice. Sounds good? That we first, take a little quick recap on the conceptual bit. And then after the conceptual bit, we start doing questions. Get the mind maps ready, get the concepts quickly reframed in the mind. Is that a good idea to go with? I guess. Wonderful. So let's do one thing. Let me, I think, share some insights now on the concept of equity methods with you. So I just want to now do some quick revisions on the concept of Ind AS 28, make some small little mind map on the agenda before we take the journey forward. So my mind is now working on a mind map on the position of Ind AS 28, that is on the equity method of application. Once you apply the equity method, there are a few things which should be crystal clear in your mind. So let me, I think, quickly run the concepts with you, make some quick notes and proceed further. Because in this 111, we generally do not get much questions except some very simple little questions. So I thought, let me spend a little good time on 103, on 110, as well as on 28. Okay, so let's make a little quick mind map on Indus 28. Now, I always tell people that the equity method as per Indus 28 involves the application of 2 steps. I would say the step number 1 is on the date of acquisition. What you need to do in the step number 1 on the date of acquisition is you need to identify the goodwill or the capital reserve. Now, my quick question to you, when you say you identify the goodwill or capital reserve, does this appear as a separate line item, or is it a part of the carrying value of the investment? What do you say? So in this particular case, when you calculate the goodwill or the capital reserve, Does this appear as a separate line item in the balance sheet, or is this a part of the carrying value of the investments? And that's rightly said. So this goodwill is not reported as a separate item. It is not reported as a separate item in the consolidated balance sheet, but it is a part of the carrying value of the investment. It is a part of the carrying value of the investment in this particular case. That's wonderful indeed. Now, when you calculate the goodwill or capital reserve, you need to compare the purchase consideration, and you need to compare this with less the share in net assets. You need to compare this with the share in net assets on the date of acquisition. And remember, when you take the share in the net assets on the date of acquisition, you need to get the net assets at a fair value. So it is quite a similar exercise what you do in terms of 110, but you need to compare the PC versus the share in the net assets at a fair value and then get the goodwill. This is what you need to do, step number one. And then you need to do step number two, which is, you can say, in the post-acquisition period. Now, what you do in the post-acquisition period is a very interesting exercise. And I always tell people that there are two important things to be done. The first thing what you need to do in this particular case is track the changes. Track the changes in net assets of the associate. Track the changes in the net assets of the associate company. So when you say track the changes in the net assets of the associate company, can I say if the net assets will increase? If the net assets will increase, what will you do with the investment? Debit or credit? The idea is to track the changes in the net assets of the associate company. So the net assets of the associate company goes up. So what do? Investment is going to be debit or credit, your inputs. And that's right, the investments will get a debit in this particular case. Wonderful indeed. So the investments will get a debit. Can I say to the extent of the share? To the extent of the share. And if there is a net asset decrease in this particular case, then what do we need to do? We need to basically credit the investment, and that is again to the extent of share. This again to the extent of the share in the increase or decrease as the case may be. So this is one thing that you need to keep a track the changes of the net asset. If the associate equity moves up, the investment moves up. If the equity goes down, the net asset also goes down. And the second important thing is the corresponding entry. So the next important agenda is the corresponding entry. That is the corresponding credit or debit as the case may be. Because in the first one, you debited or credited the investment. So what do you do in the next part is, can I say in this particular case, a mirror accounting needs to be done. In this particular case, a mirror accounting needs to be done. So can I say, what does the mirror accounting means? If the associate company credits P&L, I will also credit P&L as an investor. If the associate company credits, you can say OCI, can I say I would also in this particular case credit the OCI, correct? So we can say we need to do a mirror accounting. He credits the P&L, I credit the P&L. He credits the P&L, we credit P&L. He credits the OCI, we credit the OCI. And if he credits the equity, can I say we will also credit equity, SOKI directly. So this is the nut treatment which you need to keep in mind, that in step number one, it's all about identifying the goodwill. And in step number two, it's all about tracking the changes in the net assets. I think that makes a good point, but I have a small little question to you at this stage. When you consider the post-acquisition profits of the associate, when you consider the post-acquisition profit of the associate, are you going to consider the book profits or is there any adjustments to be done as well? So how many of the associate credits the P&L, OCI or the equity? That would be given in the question. Or you need to basically consider the transaction, which I'll do in a practical question and you'll get the feel. So by the way, when you say that we need to consider the post-acquisition profits of the associate, are you going to consider the book profits or minus some adjustments? I mean, anything else, anything to be adjusted? Think, if you remember that if there is any fair value of the net assets, would there also be a need to make any additional depreciation? Am I right? So when you consider the post-acquisition profits, you need to consider the additional depreciation as well. Okay, so far so good. That's right. I think now we are in a comfortable position to do a question with you. Let's begin. Let's have a look at the question number 18 now. In this case, it's a January 21 examination question which came for 5 marks in the exam. Let's have a look. It says on 1st April 2019, Big acquired 35% interest in Dig and it achieved a significant influence. Clerk had given it's a case of significant influence. The cost of the investment is given and the net assets on 1st April 19 is given. The fair value of those net assets is given to be 6,50,000 and since the fair value of PPE is 1 lakh more than book value. Anything coming to your mind as you read that the fair value is more than the book value by 1 lakh due to PPE? Is there anything which is coming to your mind to be incorporated in the equity method? The life of the plant is supposed to be 8 years. So what is going at the back of your mind? What are you going to make adjustments in this particular case? Additional depreciation. That's rightly said. It is going to be an additional depreciation. Wonderful. For the financial year, Dig earned a profits of 1 lakh and paid a dividends of 11,000. They also recognize a loss which arose from a remeasurement defined benefit arising out of OCI. As you were putting a question to me, how do I know that they've taken a hit on the P&L or the OCI? I think I'm very clearly given. When they earn a profits, I safely assume the profits are earned in the P&L. But there is a loss arising out of OCI to the extent of 15. Let's, I think, begin the journey. Question number 18. So let's begin with the question number 18. 5 marks, simple and straight indeed. So I think let's go to the step number 1. And that is on the rate of acquisition. We're trying to calculate the goodwill. Let's organize the data. So let's see what is the cost of investment. I think let's have a look. So copy that question. You can paste in Excel since this is a small one. No worry. I think I'll just keep moving the screen. That's perfectly fine. Okay, so we given the cost of the investment was 3 lakh. So let's take it as 3 lakh. And I think we can compare this with what? Share in net assets at fair value or at book value? What do you say? Are you considering the share in net assets at a book value or at a fair value? Undoubtedly at a fair value. That's right. So we need to consider the fair value. Good. So fair value is 6,50,000. So let's calculate out of 6,50,000. I think there is a 35% stake. Let's see, it comes to how much? That I think comes to 227,500, I guess. So I think we can get the goodwill as a balancing figure. So that is 77,500 is the value of goodwill. That is correct. Wonderful. So this gives me the calculations of goodwill. This is done. See, once you know the steps, the life becomes even more easier because you can go in a chronological order. Now let's go to the step number 2, where we're looking at the post-acquisition movements. So we're looking at the post-acquisition movements, and now we'll make a scrutiny of the question and proceed. We'll take the cost as a base in any case, and I think let's proceed with the movements in this case. It says for the financial year 1920, they earned a profit of 1 lakh rupee. So can I say we add, will this increase the net assets or decrease the net assets? Undoubtedly, if they earn a profit, it will increase the net assets. So I need to increase the investment. And in this particular case, what will be the entry? 35%. That's right. So let's consider add share in post-acquisition profits. So I think I can take this movement in the brackets. This is 1 lakh. Is there anything to be adjusted out of this 1 lakh rupee? The profits earned a 1 lakh, but there was a fair value gain, and the asset life is supposed to be 8 years. So we need an additional depreciation. We need to check what associate books the entry. In this case, it'll be P&L, of course. But I mean, the adjustments would be, can I say there is a revaluation? So we need to take care of the additional depreciation. So I guess 1 lakh was the fair value change with 8 years life. I guess the additional depreciation is 12,500. Let's take a 35% stake in that. So 1 lakh minus 12,500 into 35%, that comes to 30,625. Okay, let's go further. And then it says DIG also has recognized a loss of 15 in the OCI. So this will be increasing or decreasing the net assets of the associate. Yes, this will be decreasing. So we'll basically take care of reduction, that is less the share in defined benefit plan. So I think this is a loss of 15,000 into 35%. Let's make a reduction. And that works out at 5250. That is done. Well, I think this takes care of the calculation of the investment. So now you can see clearly this is 325, 375. Wonderful indeed. So I think this takes care of the entire calculations as well. So by the way, if I just ask you, can I say what will be the entry for this portion? Can I say it'll be investment gets a debit and P&L gets a credit? And can I say for this case, the entry is OCI gets a debit just for your calculations and the investment gets a credit. This is just to be on a very safe side. I'm giving you the insights on that. Oh, forget about the dividends. Oh, my error. I think I forgot the dividends. Yes, there is dividend of 11,000 paid. I forgot, my error. So let's take the dividends as well. So I think the dividend is to the extent of 11,000 into 35%. That would also decrease. So 35% would mean, I guess, 3850. Wonderful indeed. So this is done. So dividend also, we can see the entry is going to be bank debit investment credit. That is on the concept as far as equity method is concerned. Now we're just going to make a run through on a very interesting question on Index 28. I think Index 28 is pretty simple and straight. There is hardly any complications on that particular step. Okay, let's do one thing. Let's now take another small little question As you said, how do we consider this? Let's now have a look at question number 19. This question is there in the study mat, and this question is also there it came in, I think, RTPs or something. No, it came in the exams. November 2020, it came for 6 marks in the exam. Very interesting question indeed. So let's, I think, read the inputs. It says in the question, it says A has got a 20% stake in B, associate, which in turn has got a 100% interest in C. So A has got a stake in B, which is 20%, and B has got a stake in C, that is 100%. So basically, B is the associate of A, and C is supposed to be the subsidiary of B. Then he says B recognized the net assets of entity C, 1,000, in the consolidated financials. You can see B's consolidated financials appearing below. And then he says B sells 20% interest in C to a third party for 300. Now you would recall that when you sell the stake in a subsidiary and the subsidiary continues, you can vouch me what is the entry. It is bank gets a debit with the sale proceeds of the investment, that is to the extent of 300. And can I say in this particular case, we are given, yes, the bank gets a debit to the extent of 300, and whatever profit loss comes on the investment, because we are going to give a credit to the investment, and that is to the extent of you sold 20%, that is 200. So can I say the balancing figure 100 is going to be given a credit in terms of equity? Because you are dealing with the NCI, and when you're dealing with the NCI, that's right. So it is not taken in P&L, it's taken directly in equity. So this 100 must have been taken in the equity. So it says that it is an equity transaction, and therefore it results in a credit in the equity, and that is to the extent of 100. So when the sale of the investment was made, so the entry is bank gets a debit to the extent of sale proceeds, the investment gets a credit to the extent of 200, and the profit on sale is entered in the equity. Now it shows you the inputs out here. This is the balance sheet of B incorporating the change. So we can see the assets remains the same, but this is increased by 100. Whatever is the profit on equity, it changes the equity to 1100. The NCI appears at 200. So I think I've written that investment, it should be NCI. So the NCI gets a credit to the extent of 200, and the cash comes to the extent of 300. Now, the quick question what comes to the mind is, can I say because of this sale, did the equity of the company increase by 200? Because of the sale, did the equity of the company increase to the extent of 200? Now tell me, if the equity increases by 200, will you put an entry investment debit, P&L credit, OCI credit, or are you going to credit equity? It says A does not participate in the transaction, but A share in net assets will increase because of that 20, because of that transaction. So his amount will increase by 20. So the issue, the agenda basically is that in this particular case, when the net assets increases by 20 for the associate company, your entry will be investment debit. Are you going to get a credit a P&L, OCI, or are you going to credit equity? What do you say? Because we said we're going to do a mirror accounting. And if you're doing a mirror accounting, this increase in net assets is a result in terms of increase in the equity. So I think, let me answer that. It's going to go directly in terms of equity itself. I think that was the basic agenda in the question. Yes, the mirror accounting would result in a credit in terms of equity. Right, friends, that's wonderful indeed. So I think that takes care of our inputs in terms of the consolidation standards. I know time is always less and one would always love to do more than that, but I think, all things have to come to an end as well. So that's how the consolidation comes to an end. So I think I made a little changes in terms of giving you some kind of, mind maps prior hand. We're going to continue with the strategy in the coming sessions as well, where I'm going to give you the inputs first. Let's make a quick revisions of the concept and then do the questions. Good morning, ma'am.
Hello, sir. Thank you, sir. Actually, we have to go for some pledge ministries course, so I was in hurry. Students,
Thank
I'll
you.
just request one thing that in case, because it's a revisionary classes, we are getting feedback that the concept should also be covered. This time, I hope sir has covered the concepts as well. And in case you have any other expectations or request, you can please make to us through your feedback form. So do fill the feedback form. Thank you, sir.
Thank you, ma'am. Thank you so much.
Okay, sir. Bye, sir.
Any questions, friends, on your side? Otherwise, I think we're good for the day. Then I'm going to see you in the next session for another interesting topic to go. Right, so I think so far so good. So thank you very much, friends. I'll take a leave on that. Bye-bye. Take care. See you. Haji, thank you.